application with New York State. So if you are interested in learning a little bit more about the CFA, or some tips and tricks on applying for it, then join us on June 5th. So look out for that. And then our next connections call, of course, is June 13th at 9:30 in the morning. We do have the connections calls mapped out for the rest of 2024. So you can go on the website if you are interested in seeing the full calendar of those. If you don't know what the connections calls are, they are sort of a time when we can just get together as grant writers, grant professionals, and we share intel, we share problems, we ask each other questions. It's confidential, it's very collegial. They're very helpful, at least for me. Every single time I go on, I learn something. It's great. It's a really supportive group. If you're not a member and you want to be a member and you've paid for this event, we will happily apply the fee for today's program to your very affordable membership of $100 per year. You can use coupon code SAVE30 if you are interested in becoming a member. And Deborah, maybe you can put the link to membership in the chat for me. At the end of this session, we will distribute the recording. And of course, we put the recordings for all of our past webinars on the website for the members as well. So if you're interested in those, you can always look back. I will be sending a survey after the program, so please complete the survey. I like to get the feedback. It's nice for our presenters and for us on the program committee to sort of analyze that and see what kind of programs we want to do next, which is really great. Let's see, please mute yourself until the end. I did already send some documents that our presenter today had sent over. If you did not get those, let me know in the chat and I can send them back out, or I will drop them in the chat now. Let's see. Beth said that we can have questions throughout the program. So typically we do sort of a Q&A at the end, but I'm changing my notes here to say that if you come up with something, maybe just raise your hand, and if once Beth sees you, she will call on you, or if she doesn't see you, I will interrupt her, and we will go from there. Let's see. I now just want to introduce Beth. I'm just thrilled that you're here, Beth, with us again. Beth Zolkind, CPA, is a recent retiree who continues to serve the not-for-profit sector by volunteering with her local food pantry and by providing other pro bono financial advice. In her past life, Beth has been the CEO for the Centre Consortium and the Robin Hood Foundation. And this is really interesting. During her 13 years at Robin Hood, she really enjoyed working at the staff to hone their financial acuity. So she trained the program staff to do analyzing of audits of other nonprofits who were applying for funding. And then she also trained the development staff to understand Robin Hood's financial documents so that they can go and ask for more funding appropriately. Beth has recently been described as the ambassador of numbers, which I thought was very cool for the organization she held. But she's multi-talented. She's an avid knitter, a tennis player, a sourdough bread baker, which I loved. I stick my bread in the bread machine, so I'm not an avid baker. She did provide sort of a part one on this topic back in September of 2022, and that was so well received. We wanted to have her back, and we had a lot of new questions for her. So we're just thrilled to have you back, Beth. Thank you for joining us. And as I said, if you need those documents, just let me know now, and I will send them to you, but I'll also paste them into the chat. All right, Beth, we're all waiting patiently.
Well, great. Thank you for that nice introduction. Nice to meet everybody. Thrilled that so many people are interested in this topic. So I received a lot of questions via Michelle and Alice and Paul about things that people would like to talk about. And I could talk for weeks to answer all of these questions. I'm going to read some of the questions that came to me just so you have an idea of what people have said they were most interested in hearing about. And I'm going to try to organize that into a couple of key topics that will try to embrace all of these questions and maybe make this as relevant as I can for the perspective of grant makers. I sent around last night the audit report for Robin Hood for 2020 and 2019. I was last there in 2019. It's public information. You can get their audits up till 2022. But I know these numbers very well. I know this company very well. And it's easy for me to talk to financial relationships with a company that I know very well, an organization I know very well. They're not typical of most of the organizations that we fund, and I understand that, but finances and accounting are largely the same across organizations. So people had asked why I don't like the 990. How does it compare as a tool to understand financial health of organizations? What if there are differences between the 990 and audits? How are audited financials most important to funders? How can we use audited financials to present an organization in a positive light? What about expenses, expense ratios? Is there an optimal rate? Let's talk about the notes at the end of finances. They're complicated. How do I understand them? How can I explain them? And then what about variability in numbers? Revenue goes up one year and down another year. How do you explain that? And then somebody else just asked, I'd like to understand how to read financial statements. And then I think coming out of all of this are some very key not-for-profit topics that everybody should really understand, which has to do with restricted versus unrestricted revenue, net assets and reserves, restricted and unrestricted, an audit versus a limited review, what an opinion does, and let's talk about internal controls and fraud a little bit. So I'm going to try to touch on all of that stuff to some degree, and please interrupt me. As I was saying earlier, accounting is full of rabbit holes, and I am prone to diving deep into any of them. If I lose my audience, I don't want to be down the rabbit hole by myself. So ask me a question, bring me back up, and we'll make it so it stays relevant to what your objectives are. So audited financials are not going to tell you everything that you need to know about an organization that you're contemplating to make a grant to. But they're going to be clues that you get out of the financials that'll give you a sense of the organization's capacity, their financial stability, their track record. And you can use that as a jumping off point to then access internal documents, budgets, and projections. But the audit should give you a baseline. And because the audit has been written, has been reviewed and opined on by an external party, those numbers are the best starting point that you've got when you're looking at an organization. So first, audit versus a review. If you raise $250,000 or up to $1 million in New York, you need to have your financials reviewed by an outside CPA firm. A review is a very light touch look at your numbers. They'll look at your cash balances and make sure it agrees to the bank. They'll take a look at your largest donors. They will make sure the required disclosures are on your footnotes that FASB wants to have. But they're not going to go in and test the numbers. They're not going to make sure that all of your revenue is real. They're not going to give you the degree of comfort that you get with an audit. If you raise $1 million or more in New York, you need to have an audit. And an audit is going to be a significant set of procedures that detail test the major accounts to make sure that in all material ways, the numbers that are presented in the financials are fair and represent fairly the financials and the books and records of that organization. That's not fraud. They are not saying that we haven't found fraud. They're not saying we're looking for fraud. They are not saying that there is no fraud. They are only going to say that, generally speaking, based upon reasonable testing, we can say that these numbers fairly present the numbers of the organization. Okay, so far? So also, you will often get a management letter from an accounting firm, and the management letter will address internal control weaknesses. This is a really important document, and if you can ask for it and you can get it, I think it tells you a lot more about an organization than just the numbers. It talks to the commitment of senior management to ensuring that the assets and the books and the records are properly protected. And it gives you some assurance that they're going to protect any grant that you give them. A management letter will often give you the same kind of accounting language that says, in all material respects, no material weaknesses were noted. But you may also get points that talk about internal controls over cash, internal controls over the books and records. If you've got the same person who is opening the mail and depositing the checks and reconciling the bank statements, you've got an internal control weakness. What are the compensating controls to ensure that that person isn't depositing the check to their own account, adjusting the books and records, and misreporting out? In little nonprofits, it's really hard to get adequate internal controls. There aren't enough staff people. And the degree to which management is able to pull in people outside the finance office to do these tasks will speak to the commitment that they have to the internal control process. So I know at Robinhood, when we were starting out, we were very small. I had one other person in the finance department, and I had the receptionist in charge of opening our mail with somebody from the program team just sitting up next to him. So one person listed all the checks and one person opened the mail, and there were two people. That list would then go to the finance department, and I knew that this information was out there and there was nothing that was going to happen in the finance office that was going to in any way pervert that information. So internal controls are really important. Fraud. I'm just going to talk on that briefly because it's been on my mind a lot. Every nonprofit that I have ever been associated with has had some degree of fraud. It just happens. Sometimes it's theft and it's not fraud. Theft is somebody goes and takes something, and it could be somebody outside of the organization. That's different than fraud. Fraud generally involves some degree of deliberate manipulation or deceit. We had fraud at Robinhood. We had two of them. We had fraud in every organization that I audited prior to coming to Robinhood, either before I was there or we discovered it while I was there. It's ubiquitous. Not-for-profit employees are not typically the highest paid people. And there's a concept called the fraud triangle, where you have an incentive, you have an opportunity, and you have rationalization. And if those three elements are present, you have the makings of a potential for fraud. The incentive, I need money. My car broke down, I can't get it fixed. The opportunity, I have control of the checks coming in and the books. I can definitely sign a check over to myself and adjust the books in QuickBooks. No one will notice it. The rationalization, they don't pay me enough money. That guy over there makes more money than me and I'm worth more than he is. Typical, happens all the time. I could tell so many stories about how fraud happens. And one of the best ways of discovering it is having the little old bookkeeper who never takes a vacation finally is away from her desk for a period of time and somebody steps into those shoes. And you find the most trusted person in the organization is the one who has been taking a little bit of the leftover money in a grant that never was returned back to the grantor, and somehow something's been charged against it that had nothing to do with the organization. It's amazingly common. And it's worth having a conversation with senior management, not because you would ding them because they had a fraud. What you're interested in is how did they respond to it? What controls did they put in place afterwards? How did they discover it, and how are they going to ensure it doesn't happen again? You can bet that it happened. You can bet that if it hasn't happened yet, it will happen because the odds are just huge. Some Robinhood one was a $6,000 fraud. It was so silly. This guy was able to electronically forge a signature to a credit card that was offered by Pitney Bowes, and he was able to Photoshop a new Pitney Bowes invoice. And the invoice that was Photoshopped looked nothing like the actual invoice, but he opened the mail. So he got the invoice. And so we paid what showed up until he was sick one day. And then we went to Pitney Bowes and had them send us all the invoices again. His whole fraud was $6,000 in a $300–400 million organization, and he lost his job. These things happen. People will do it for the dumbest reasons. Michelle.
So I have a question. If
Yep.
a fraud occurred at your organization or an organization, would that come up in the financials?
Not necessarily, not unless it was really material.
So if you had it, if it did come up and the steps were highlighted that the organization took to sort of remedy that, would you bring that to the funder's attention, do you think?
It would come up in the management letter.
Okay.
The management letter would
So
report.
they would see it anyway if they required your financial.
If you ask for the management letter, it should come up in the management letter. It absolutely should. And then the management letter would include management's response. And they could talk about the control weaknesses that enabled this to happen and talk about management's response to that control weakness. And that the auditors would sign off and say, I believe these procedures mitigate the risk of this occurring again.
Thank you.
Okay. Good so far? Okay. So let's go to the numbers. So this, I talked a little bit about internal controls and a little bit about fraud, and essentially said that the opinion from the auditors doesn't address either, except to say that nothing hit them in the head while they were looking, because they really don't want to assume any responsibility for detecting fraud. But that nothing hit them in the head when they were doing the audit to present fraud, and that the books, the financials fairly present the numbers of the organization. So I'm going to try to share my screen now. Let us pray. Let's see if this works. Okay. I'm sharing the larger document that I sent over last night. This is the full audit report of Robinhood 2020 and 2019. The smaller report I sent over are just the financial statement tops. And I thought if you could print it out, if we get to talk in that level of detail, it might be easier to have a printout. So there's the opinion, the auditor's responsibility, and in our opinion, the financial statements present fairly. Here's an interesting point. The date is August 2nd. Robinhood has a December 31st year end. I have heard in different seminars that if your audit takes place more than 6 months after the end of the fiscal year, you've got a problem. I'm here to say that that's just flat out not true. It has everything to do with what's convenient for the organization and what's convenient for the auditors. And 6 months after Robinhood's fiscal year end, we're still cleaning up from our major event of the year. And there is no way we have any ability whatsoever to deal with an audit. So that's going to be a theme of everything I say along the lines of ratios and fixed numbers and rules of thumb and things like that. I don't like them because organizations are individual, and it's worth taking the time to understand the specifics of something that looks like it might be an anomaly. So we've often had our audit August, September, October, whenever it was convenient for us, because we had a small staff, we had a lot to do, and that's the way we worked it. So here's the statement of financial position. And I know that the organizations we're funding here are not this large. Drop 3 zeros, drop 3 numbers at the end to make it relevant, but organizations are all the same. What you see, and you'll see it for a lot of organizations, is a ton of cash on December 31st. Most organizations have a ton of cash on December 31st. They also tend to have a ton of pledges on December 31st. And if they're accrual taxpayers or accrual financial reporters, and that's because people make charitable contributions at the end of the year. So you will find Robinhood's cash is at its highest on December 31st and in January. The food pantry that I work at, the cash is the highest in December and January. And that's fairly consistent. And then there's a whole bunch of other numbers, but you'll see that the only liquidity, real liquidity, is cash. Everything else is short-term pledges and investments. There's no liabilities to speak of except for grants. And then you have all these net assets. So I'm going to take a second and just talk about what exactly are net assets. And net assets is another way of saying an organization's wealth. It's the same as for an individual. If you earn $1,000 and you had $200 of expenses, at the end of the year, you had an $800 profit. If the next year you had the same $800 profit, at the end of 2 years, your cumulative wealth is $1,600. That's the way you get net assets. That's the way you get reserves. That's the way you get wealth. It's retained earnings in a for-profit organization. It's the cumulative profit from year to year, year over year over year. It builds up, and that's your net assets. In not-for-profit organizations, people that give you money give it to you two ways. They can give it to you unrestricted, which means management and the board can use that money however they see best serves the mission of the organization. Or they give it to you with a restriction. And the restriction is one of two kinds. The restriction says you can only use this money for this specific purpose. I want you to use it in early childhood programs, or I want you to use it to put food in the food pantry. Or it can be a timing restriction. Here is a $500,000 gift. You can use it over 5 years, $100,000 a year, but however you want to use it. So there's purpose restriction and there's timing restriction. These restricted donations really mess with your profit in any given year, because in year one, when I get a large restricted donation, I look like I had a huge profit. In year two, when I spend that money for the purpose for which it was given to me, I look like I had a huge loss, because I'm spending in year two money that I raised in year one. And that can be very confusing to people looking at financial statements. So we'll get to that as well, but I just want to put those concepts out there so that you can kind of hone in on it. So and there's a third restriction that isn't really a restriction. The board can take unrestricted revenue and say, we are going to take this money and we, the board, are going to take half of it and use it for a new childhood education fund that we want to focus on. So that's now restricted, but it's not the same as if a donor did it. If a board does it, it's called board designated. And it's truthfully unrestricted, because the board could say, all done with the child fund. We're going to now make this a homeless shelter. They can change the restriction, and there's nothing any donor would have to say about that. Whereas if a donor gives you a restricted donation and it's for a program that you are no longer funding, you can't just repurpose that donation. You've got to go back to the donor and ask for permission to repurpose that donation. So we categorize board designated reserves, net assets, the cumulative profit of these board designated donations, along with all the other donations that are unrestricted, in the unrestricted without donor restriction category. And then all the restricted donations, the timing restricted or the purpose restricted, are categorized separately. Okay, so far so good? Yeah. Okay. So that's just one more thing. That's the balance sheet, the statement of financial position. You will always see your assets equal the sum of your liabilities and your net assets. Or another way to look at it is, if you take your assets, you subtract your liabilities, you have your reserves. If you take your revenue and subtract your expenses, you have your net profit. You add your net profit from year to year to year, you have your total net assets. It's two ways of looking at the same concept. So here is the statement of activities, shorthand called the P&L. And I like this format a lot because, first of all, I think if you look at 1 year of financial information, you have no idea what you're looking at. You've got to look at 2 years combined to have any idea of the flow, what's consistent, the changes are what's really interesting. And then this is a very clean way to show revenue that was received without restrictions and revenue that's received with restrictions. Now, a quick segue to the 990, which I really don't like. The 990 reconciles to the financial statements. There's a Schedule 11 and a Schedule 12 where any differences in the presentation of numbers on the audit and on the 990 are reconciled. And there's some differences. Things like donated services is not included in the 990. There may be other things. That's the one that occurs to me off the top of my head. Maybe different ways of accounting for depreciation. There may be different depreciation reportings. But you don't get this kind of clarity. You can't look at revenue on the 990 and understand this. You get different pictures of revenue, but you don't get this kind of clarity, which to my mind gives a very clean idea of how the money's coming in. So what the 990 is good for is on the expense side, it's interesting to see salaries. It gives you an idea of how they're compensating people. I think that's always interesting. You get to see the board. You get to see how much of their contributions are coming from a very few number of people to get an idea of the vulnerability of the organization to one or two donors losing interest. Couple of things, but those are big reasons why I don't like the 990. So here we have the P&L. So if you look at the revenue at Robinhood is received two different ways: through contributions, forget the little numbers, through contributions and through big fundraising events. And so we break it out. Contributions, some of them come in unrestricted, some of them come in restricted. And you look at year over year, there's variability, right? And annual fundraising events. Some of it comes in unrestricted, some of it comes in restricted. Now, I know the way that Robinhood works, and other organizations work this way as well. We will raise money at the benefit, and we may raise money because we want to build an immigrant defense fund. We want to build a fund that will provide bond support for people that have been detained. So we put up a mission, and then people will donate to that mission at the benefit. That's the way you would get a significant number of restricted donations at the benefit. There may be a year that we are doing a big raise. There is a year that we're doing a smaller raise, but that's how you get restricted money at the benefit. Typically, ticket sales are not restricted. Typically, when you buy tickets to a benefit, it's unrestricted revenue. Then the direct costs of the event. The reason that this is proper financial presentation, these are costs that could easily go over on the P&L. It's really important to know if you're buying revenue. And there are way too many organizations that think big events are the way to raise revenue. But if you actually look at the cost of putting on those events, they're not really making money at it. So the direct cost of events is something that needs to be looked at, because not only are the direct costs relevant to the benefit, but there's management time that's been spent on this benefit. There's probably fundraising staff. There's most likely the executive director. There's a lot of costs. There are a lot of costs associated with running a benefit. And when organizations spend a great deal of money on benefits, and that's their major fundraise, it's important to look at that, because that may be a case of buying revenues. So the other little numbers are donated services, donated goods, party bags, and things like that. And then you get that number. And then there's a bunch of investments. You get investment income, you have realized and unrealized gains, and that's your investment revenue. So here is the total revenue for the year: 220 in 2020, 166 in 2019. Now you've got this funky line: net assets released from restrictions, which is really confusing. What this means is, in 2020, we satisfied restrictions on donations that were given to us prior to 2020 so that we could spend that restricted money. But expenses are never restricted. Only donations are restricted. So you've got to move that revenue out of the restricted column into the unrestricted column so that you can use it for expenses that have met the criteria that the donations were given to us for. Does that make sense? It's a little complicated. I'll move to the next page on expenses and you'll see it better. Here are all the expenses. You'll see there are no expenses in this column, but there is all that revenue in this column. If you're not going to put expenses in this column, how are you ever going to use that revenue? The only way you're going to use that revenue is by moving it to that column. Now I can say, okay, $138 million was given to us in prior years, and we can use that money. Either it had timing restrictions on it, which meant you couldn't spend it before 2020, or it was to be used for program expenses that we now are incurring so we can use that money to fund those program expenses. And so there you have a lot of that money went in there. Some of it went for relief, and some of it went for management assistance, core grants and management grants. None of it went for overhead. We did not receive any restricted money to fund overhead, although conceptually you could get a restricted grant to buy a new computer system for an organization, in which case that restricted grant would fund overhead. Robinhood's overhead is paid by the board, so we don't ever get restricted money from them. Does this make sense? This is a hard concept. It's confusing, but it's important to understand when you're looking at an organization's financials, you need to be able to differentiate the restricted money they've got and their unrestricted money, because their regular operations are largely funded with unrestricted money. If they're going to fund, I'm moving to the functional expenses, if they're going to fund all of their salaries and all of their overhead, they need to have unrestricted money to do that. And if all they have is restricted money that is meant to put food in the food pantry, or a truck for delivery to the food pantry, or keep an early childhood center working, that's great revenue to have to fulfill your programmatic mission, but you've got to have unrestricted money to run your operations. Questions? Am I confusing anybody? So far, okay? Okay, all right. So we talked about restricted and unrestricted revenue. We talked about how restricted and unrestricted net revenue less expenses on the unrestricted side lead to net assets. On the smaller package I sent over, I did a bunch of number references to show how these numbers relate to each other across the financials. I don't know that we're going to have time to do that together, but it's an interesting kind of a blueprint to follow if you're curious. And if you're looking at it and it doesn't make any sense, shoot me an email and I'll walk you through it. But it ties all of this together so you can see how these numbers flow from one side to the other. So here you have expenses. And Robinhood is a grant-making organization. So if you know about a grant-making organization, what you would guess is that their biggest number is going to be their grants, and their next biggest number is going to be compensation, which is pretty much what you see. 171 million in grants and 23 million in compensation, right? Look at the difference in grants between 2019 and 2020. 2020 was the first year of COVID, and Robinhood raised a COVID relief fund immediately upon March of 2020. I think it was about $72 million. We'll get to it later, and immediately started putting relief grants out into the community. So you can see relief was very low in 2019 because the prior relief was 9/11, which had largely been spent out by now. Sandy relief, Hurricane Sandy, there was a relief fund, and a ton of grants were raised, a ton of money was raised, and grants were distributed to all of our grantees who suffered physical damage in Sandy. Were stepping up food services and all to people who were without shelter. And then there's the COVID relief fund. It was the third relief fund Robinhood raised. And you can see the variability. Compensation is pretty consistent. You know, they do a lot more grants with the same number of people, which brings me to another point, ratios. So on any given day, a deposit slip from Robinhood would have $1 million check from a hedge fund guy and a $5 check from a lady in a payroll department who gave $5 every single payroll to Robinhood. It takes the same amount of work to deposit $1 million check as it does to deposit a $5 check. So when you look at the kind of numbers that this organization has, there is no reason to try to look at ratios because we look like the world's most efficient organization ever, right? Management in general was $4 million on total expenses of $202 million, right? You got 2% of expenses, you got nothing. Here I go. I'll go 4 million. 4 million divided by 202, right? You've got 0.19, 2% in expenses. That looks like a pretty healthy ratio, right? It's unreasonable. You can't look at that. You have to pay people a minimal amount of money. And if the donation level isn't in the hundreds of millions of dollars, the ratios that they're going to incur have to be higher. So if you take off 3 zeros, the same $4 million management in general on 22 million is not such a great number. Now you're looking at 12%. It's not such a wonderful number. A more interesting look, to my mind, is if you say, this is one set of expenses, all of the grants. What was management in general, let's say 6 million, compared to just the non-grant expenses, the $31 million, right? That's not such a Herculean number. That's not such a great number. That's 6 million divided by 31. Now you're looking at 19%, right? Sort of okay, but not phenomenal, right? And if you look at management in general and public information and fundraising, you're looking at 11 and 6, you've got 17 million out of 31, you're over 50%, you're at 55%. So what does that tell you? It tells you that you've got to look behind the numbers to see how they are spending their money. When we look at how much money does it take to raise a dollar and how much money does it take to make a grant, we look at the full cost of the organization and we only look at it relative to ourselves over time. We're not interested in what other organizations do. You don't typically see a $10 million or $8 million benefit from another organization because they're not typically raising $50 or $60 million at a benefit. But if that's your donor base, then you can spend that kind of money. What you want to do is you want to take a look at how has this organization trended over time? Have they suddenly bloated in a line that was smaller before? And if they did, what happened? Was there a reason for it? Are there severance payments in that number that hadn't been there before? Was there a signing bonus for a new staff person? Did a car break down and they had to do some unusual repairs? You can't just look at ratios. They're really misleading. So far, okay? Okay. So that's the functional. And then also, just so that you know, when you look at these numbers, the totals are going to reference up to the expenses over here. You'll see those numbers over here. 185 for the program is going to agree with the 185 for program. I don't ever look at expenses on the P&L because this means nothing to me. I only look at expenses on a functional allocation because this is really interesting. How people spend their money, how they allocate is really interesting. And it's also worth asking organizations, how are you allocating your executive director? If you don't see any compensation, but they raise money, you want to know who is doing the fundraising. There's got to be compensation in here. I also don't like miscellaneous. It's a pet peeve. There's no reason for them to be miscellaneous. Everything that an organization spends its money on has to fit into a category. So you shouldn't be just hiding money in miscellaneous. Okay. So we talked about the balance sheet, we talked about the P&L and the functional allocation. Cash flow is complicated, and it's really worth a whole hour on its own. The point of the cash flow is to be able to see you've got 80 million in cash. How did you get it? Did your cash come through because you sold all your investments? Are you freeing up cash because you're not paying your bills? This is where ratio analysis can be helpful, but it's sort of helpful just to understand how this stuff works. The idea of sources and uses is kind of backwards. So if you get a lot of pledges, it means you've pretty much used up cash, because if you liquidate those pledges, you've received cash. So increasing pledges uses your cash. Decreasing pledges gives you cash. The opposite is true of liabilities. Increasing your liabilities conserves your cash. Decreasing your liabilities meant you paid your bills off. A lot of organizations will use this to window dress their cash at the end of the year. So if you take a second and go right back up to the balance sheet, sometimes what you will see on a balance sheet is you'll see a good cash number, but you'll see that pledges has gone up hugely. Pledges receivable have gone up hugely, right? So they haven't gotten, I'm sorry, I'm telling you backwards. I'm sorry. Cash will be a good number, but they've pulled down their pledges because they've gotten the cash from their pledges. They've pulled in as many pledges as they can, and the liabilities will balloon, so they haven't paid their bills, right? So I would look at this and say, okay, grants have ballooned, but I've got enough cash in my balance sheet right now. I could pay that liability if I needed to. So probably I'm not window dressing my cash. I said that backwards, so I want to say it again so I don't confuse you. If you see that pledges have come down, you would expect cash to go up, right? Pledges have come down, you'd expect cash to go up. When you see liabilities have gone up, you would expect cash to come up. And to make sure they're not window dressing, you just want to make sure. You have to understand what this liability is, and you want to take a look at this cash, but you can be pretty sure that they're not window dressing, that you've got enough cash to pay your liabilities. Is that a question? No?
Please mute if you are not asking a question.
Okay. So that's about all I'm going to spend on cash flow, just to take a look, just to know that you want to be mindful of changes in the balance sheet and to what extent the cash balance is being manipulated in an application for a grant. So now we're down to the notes. And one of the questions that was asked is, how do you use the financial statements to show the organization in a positive light? And I think this is like one of the most important uses of financials. And it's one of the ways that the audit report really excels compared to the 990, which you have Schedule O, and you can write a whole lot of stuff in Schedule O, but it's hard to read, and it's at the end of a very long legal kind of a document. And this is much more upfront. So we would spend at Robinhood an enormous amount of time on Note 1, and would circulate it to every leader in the organization, program and fundraising, to make sure that whose ever eyes are on it, the statements in this section met the needs of their perspective. And you tell, this is your organization, this is what you do. We're meeting urgent needs, we're helping people get themselves and their family out of poverty. This is what we do. And we would bullet our main programmatic areas. talking about this is how we do it and that we're tax exempt. And then there's a bunch of boilerplate stuff that you just can't help. FASB requires you do it. And so there's a bunch of stuff in here that explains board designated, donor restrictions, not restrictions, what investments are, how you record them. This is all boilerplate, and there's nothing you can do about it. So you just get past it. Some of it is interesting if you don't know, like program-related investments. There's some learning in there. And it addresses every major item on the balance sheet. It talks about what those items are. So this, you're not really going to have much input into. You've got to describe it. So then another question, this is a fairly new footnote requirement, liquidity and availability of financial assets. And this came out after 2008 to make sure that organizations have the liquidity to be a going concern. And so they have you go through and first of all, describe what your cash is. And as I said at the beginning, cash has moved all over the place. It's at its highest on December 31st, and lowest in November before gifts come in. And that our policy is to budget cash to make sure that there is always enough liquidity to fund at least the following quarter. That's a good question to make sure you ask organizations when you're considering funding them, is tell me about your cash reserves. How long do you budget to ensure that you have your sufficient liquidity? Deborah.
So since many of us are actually writing the grants to apply to organizations, if we are, and if you're somebody like me, a consultant, or I'm sure this actually applies to somebody who works in an organization too, and you are not seeing this level of detail in the audit reports, and you want to make sure that there is a level of detail, especially if something's happened, and you want to be able to portray the organization in the best light. What's your advice in terms of, what should we say to decision makers we're working with?
So let me make sure I understand the relationship. You are a consultant working for an organization to apply for grants for them.
Yes, and there are lots of others like me here, plus a lot of other grant writers who work for a school district or an organization, and they're applying for grants, but they may not be involved in the audit process. We're kind of handed the audited financial statements at the end.
Right. So what I would do is I would look at some of the questions which I thought were really important and would be key to anybody looking to give us money, and make sure that they had the information that they needed to make a good decision. So if they did not have, say, this footnote, which describes completely the financial assets available to meet cash needs within a year, if they did not have this footnote in front of them, I would go back to management and say, I want to talk about your cash reserves in my grant. I want to talk about how much you have available and how you manage that cash to make sure that it's available for the next quarter or 6 months or whatever. And I'd like to have a spreadsheet from you to support that. And I would go back to them and ask them, any accounting department can put that spreadsheet together. I wouldn't hesitate to ask for supplemental material. One of the things we did in this audit, and I did from the time I started there, I felt that this is such a good tool. And the people that Robinhood raised money from was largely the finance community, largely hedge funds and private equity. And they're very smart people that feel like they know numbers a lot, and they're very suspicious. It's their job to be suspicious of numbers. And I wanted to get out there with as much disclosure as I possibly could, so that, with an abundance of sunlight on all of the numbers, you would immediately dispel any concerns that something was amiss. So a lot of smaller organizations don't have that perspective or haven't the resources just proactively do that. But where you think that there's the opportunity to shine a good light on a story, go back and ask them, give me a spreadsheet, give me a small analysis that I could support that with. That's what I would do.
Great. Thank you.
So
Beth, it looks like there's another question from Brian.
Oh, I don't even
Is
see.
that
Okay.
okay?
Yeah, I can't see that person. Who?
It's okay. So the
Brian.
quick question is, this is really valuable, and I really appreciate you going through this in the kind of detail that you are. It's very helpful. As you know, I've been writing lots of grant applications, and I don't often see a place to really promote or tout the, fiscal health of an organization. I mean, foundations or, corporations, they ask for financials, but they don't always give you an opportunity to explain them. And often they are looking for an explanation of expenses in more detail. They're not sort of looking for this. So where would you put this in an application? Is there a place that you could insert this that it would be helpful?
I have never applied for grants, so I'm not sure how rigid the process is. But it would seem to me that you would be able to insert an audit report as uploaded material to accompany any other documents that are required.
Sure.
I would think you could just upload the whole audit report.
Right, absolutely that point. But where you might want to highlight a, sort of positive cash flow separately from the audit report, maybe somebody else has a suggestion.
Deborah, do you want to answer that?
I have a suggestion. Brian, as you say, there isn't always an opportunity, but if there is an opportunity, if you're putting a budget in, I would try to include a narrative, budget narrative, and have something there. Even if it's not directly related to the expenses that you're going for in the grant budget, if there is any part of the application where they offer you the opportunity to add some additional notes or information, if they're asking things like, probably not at this point, but, recently at least, they would have been asking things like, how did the organization fare post-COVID? How did COVID affect the organization? How have you recovered? Anything like that. If they're saying additional notes, if they're giving you an opportunity to put in a budget separately and there is any kind of space to, just say anything, and if there's any post-COVID commentary requested, I think those are opportunities.
I think I would add on to that. I completely agree. And in that space, perhaps reference the page in the audit report to support your statement. So if you're going to make a statement that you have sufficient financial assets available to meet cash within a year, you can reference note 3 so that it's not just you making a statement, that there's support within the audit report for that.
And sometimes there's a space where they ask, why is your organization the best organization to do this work, for example, or something like that. And you can sort of go back to your strong financials. I think Shelley also has a question.
Hi, Beth. Thank you. I agree with Brian. This is really helpful. I have a question. How important is it to you that you see that the organization is actively spending the donations that come in? So, for example, in the beginning of your presentation, you noted that, well, XYZ company brought in, large donations, either restricted or non-restricted, and then the next year they spent it, and that seemed like a negative to you. But isn't that positive that the organization is spending the donations that come in actively? And if not, do you want to see, isn't it sort of a negative that you're seeing tons of money being built up over the years, but not being spent? I've always wondered about that.
I am so glad you said that, because then I must have been unclear.
Okay.
When I said it was a negative, I didn't mean it was a business negative. I mean, if you didn't have restricted revenue in a year, but you spent the revenue from the prior year, it will look as if the net assets were negative in that period.
Oh, okay.
Not that it was a negative, it's actually essential, right?
Okay.
And it's very much of a positive. And it's something, and to go even further, this is not your money. In an organization, none of the money you raise is your money. It's not your wealth. It's not your profit. It's not yours. You are the custodian of money that was given to you at a tremendous tax advantage by a donor the gift of a tax advantage by the government to fulfill your mission. And your mission is not to stockpile that money. Your mission is to get it out and do good with it. So I completely agree that the money needs to be used prudently and promptly. And but on the other hand, you do need to be able to explain that if in 1 year, if you raise a ton of restricted money, and the next year you don't raise restricted money, but you spent all the restricted money that you raised the year before, you're going to look like you had a loss, but you didn't have a loss. You used money raised in the prior year.
Okay.
And that will need to be explained because sometimes it's very big swings. And you do need to explain it.
Okay. Thank you for that.
Okay. No, thank you for the question. It was really good.
So if you're trying to explain that, would you go into your cash flow? Would you look at assets versus liabilities, or would you look in at your functional expenses? I guess that's why you have a 2-year audit also.
The best way to explain it is in this case, on footnote 12. Was it footnote 12? It was in the page that I sent out separately. And I'm just going to scroll to it quickly since we're on that topic. This is not always in audit reports. It should be. It's like the best footnote ever. This is something called net assets with donor restrictions. And I'm sorry it's so small, but it is in that. Let me see if I can make this bigger. Is that any bigger? Can you guys see that a little better? Okay, no, it's too big. Make it a little bit smaller. Okay. What this shows you, these are all the donor restricted projects that Robinhood was doing at this time. And it shows what the balance was at the beginning of 19, how much was given into that, how much was spent, and what's left over. And it's really easy to see. For example, in this year, you raised $55 million for COVID, and we didn't spend any of that money, right? At the end of 2020, that's all left over, right? In this year, this is on recovery. That's the recovery fund, sorry. In the relief fund, we raised it that year and spent out that much of it. Let's see, what's a good one? In this year, we didn't raise any money for the Job Connections project, but we spent $5 million that had been raised in 2019. So if the only thing that had existed was this one line, Job Connections, what you would see is 0 revenue in restricted donations, 5 million spent, and it would look like there was a 5 million loss. And what had actually happened was in your reserves, in your net assets, in the wealth that you had accumulated from the prior year, you had this $10 million contribution sitting there. But because there was no opportunity to spend that money in 2019, the criteria that this was given to us for were not able to be met in 2019. That whole 10 million was still there at the end of the year. In 2020, they spent half of it. Is that clear? Does that make it a little bit clearer? Yeah.
Yes.
Okay.
Thank you.
Okay.
I know that some people have been dropping off, so I just want to say that we will send out the recording if you're missing this.
Oh gosh, look, again, I ran over.
Q&A chatting. But if you are willing to stay, Beth, and if everyone else is, then I think we should continue, if you're willing and able, I think we should continue the discussion.
I can talk for a little longer. Just tell me when we're down to tell me when I need to stop, but I'll keep going for a little bit. So we talked about, I'm not going to go through investments and things like that, but when you talk about how do you change how do you use your financial statement as a selling tool, this footnote is not required. This is the note on investments, and there is no requirement that you list every single fund that you're invested in. We do because Robinhood raises a ton of money from hedge funds, and this is kind of a selling tool. These are the top hedge funds in our universe, And it's kind of a bragging right that says, look how much we are invested in your funds. And a lot of these people are on Robinhood's board and friends. And so if you are one of these hedge funds and you are one of these guys that has given money to Robinhood as a donor, you want to see that Robinhood is well invested in your fund. So it's a thank you in a way back to the top donors. That's one way to use your financial as a selling tool that's relevant to them. Another way that's relevant to them, this is required disclosure. This is an important point. Everybody used to talk about carried interest, and Senator Grassley for years was all over Robinhood and other not-for-profits like us that were highly funded by the hedge fund community, that they would get their 2 and 20% of fees from investments that Robinhood made in their funds, and then they would get tax deductions for the donation they gave. So they're getting this incredible benefit in their fees, and they're getting a tax deduction. And it didn't matter that our board members and all of these guys didn't charge us fees. Robinhood never paid fees for their investments in hedge funds. But you can't really say that because it was always quiet, or they would give the fee back to us. So we had to disclose, we had to divest out of every single fund that was managed by a board member. And we're down to nothing but $2,400 left for one fund that continues to be locked up for a couple of more years. But this disclosure is so de minimis. Really, we have 3 paragraphs to address $2,400 on an organization of this size, but you do it to preemptively dispel the criticism of giving double tax benefits to the richest people on the planet. So that was the point of that. Another selling point that we did, this is related parties. And a lot of our staff and our board and, staff and leadership have relationships with many of the organizations that we fund. And we felt it was really important to disclose that because on the one hand, people would say, oh, now look, you're throwing money in the direction of an organization where you're also sitting on NYU's McSilver Institute. And our perspective was, we deeply know the organizations that we fund. We deeply know them to the point that we are on their boards, not that there's conflicts of interest. So that would be our point. Another one, this is not a required, nobody does this but us, but one of the things we did was we always worked to get different consultants to provide services to our grantees. And we directed legal services over there and real estate and whatever. And this would be pro bono services provided by all of these partners to all of our grantees. And we wanted to call them facilitated donations. Not only do we make grants to our grantees, but we would direct professional services to strengthen them. And we value that. That was another little tooting our own little horn there. And then one last point I'll make that's not just boilerplate. I did that one. A really big one that we do is at the end of the audit. It's called Schedule 1, and the auditors will disclaim that they don't audit the schedule. It's supplemental information. They tie it up, they make sure it agrees in total, but they don't look at it. We list every single grant we make. And you can see all the relief grants to a lot of grantees that had never gotten money or hadn't gotten money in core dollars. The regular got relief dollars in 2020. And there are a lot of grants. And this is its own little pro sheet to say, look who we're funding. Also, everybody that we do fund likes to look and find their name in here and then come back to us and say, how can we give him so much more money than me? But that happens. But then you see that this much money has done good. So that's what's out there. So I think I can stop sharing for a moment. I think I hit all the questions that did I leave anything on the table here? Is there anything that you all still want questions to follow up, or call me, email me if you've got anything after this? I'm happy to fill in or clarify anything I said. You're good? You're happy? Thanks, Allison.
Thank you.
Okay.
I'm so glad you said to ask for more supplemental material, because I never think to do that with my finance team. Like, they can get me more information and I can use that. I
They
absolutely will
can,
do
and
that.
they're
Thank
probably
you.
happy to do it, because anything that you can do to show your strength, it's so important. And we get so beaten up in the nonprofit world. I'm working with a few other organizations, and they're small and they need money, and nobody's paid enough money, and everybody's wearing too many hats. And it's easy to get beaten up by it. And it's so important to step back and see, but for you, who's doing this work? And, like they say in the Jewish religion, you save one life, you saved a world. It doesn't matter how many you're reaching. If you're helping someone, that person's going to be somebody. It's really important. And the more you can do to get that money to the best places, it's really good work. So if I can be helpful, please feel free to reach out.
Well, on behalf of the whole program committee and GPLH, thank you so much, Beth, for this excellent presentation.
Thank you for listening. Thank you for the whole accounting spiel. Yes. Thank you for sticking.
And thank you, everyone, for coming and staying with us 9 minutes over. You never get that, so thank you so much. I will be sending out a survey so you guys can give me some feedback, and I can bring that back to the program committee. And we will send the recording when we have it, probably next week. So thank you all so much.
Thank you. And thanks for all the help, Michelle. Appreciate all of it.
You, Beth.
Okay. Bye.
Thanks so much.
I'd like probably stop the recording, Deborah, too.